Welcome back to Helping Make Sense. Today we're going to talk about different types of investments and what might be right for you at any given time, given your goals, your risk tolerance, and other factors we'll get to later in the video. The first investment we can discuss at a very high level is stocks. You've probably heard of a stock before, just the term. Basically what it is in its simplest form is the share of a company. So let's take Apple, for example, pretty well-known company. If you purchase a share or 10 shares or 50 shares of Apple, you own that amount of stock or equity in that company. Some stocks will generate what are called dividends, which is on either a quarterly, annual, semi-annual basis. That company will pay out to its shareholders a certain percentage of the amount that they own in the company, which is called the yield. So if you own, let's say again, Apple, and their yield is 5% and you have $100 worth of stock in Apple, every year you would earn an additional $5 by way of a dividend. Again, that payment to you just for being a shareholder. Not all stocks do this. The ones that do, you would know just based on your research. But just because a company pays out a dividend doesn't make it a great investment. Similarly, just because a company does not pay out a dividend, that does not mean it's not a good company to invest in. So a dividend is a good thing to consider if you're looking for other means of income, but a dividend is not inherently a good or bad thing depending on, again, your goals. The second type of investment that is probably going to be the most useful and the most relevant for most average investors, people looking to grow their wealth, are different types of funds. And we'll talk about some terms that you've probably heard before and some of the differences between the two. You probably have heard the term mutual fund. Basically what a mutual fund is, it is a collection of between 50 and 200, sometimes more, companies that when you buy into that, your money is spread across all of those companies. So it's inherently diversified. We'll talk about diversity a little later and what that means when it comes to investing. But for a mutual fund, they are managed by financial professionals who will buy and sell within that fund different companies. But again, it's automatically much more diverse than a single stock would be. If a single stock, for example, were to go down, let's say 10-15% in a given day, that means the value of your portfolio went down that same amount. Whereas in a mutual fund or any other type of fund where there's a whole bunch of companies across the board, if one company takes a dive one day or even over the long term, that doesn't mean that your entire investment in the portfolio also went down. The other type of fund that you may be aware of and is a really, really good investment, especially for passive investing where you're just putting money in, you set it and forget it and let it grow, is an ETF, which stands for Exchange Traded Fund. Similar to mutual funds, exchange traded funds have inherent diversity. The investment is spread across a bunch of different companies, so that if one of the companies within that fund goes up or down, the whole investment isn't going with it. It's diversified. Similar to ETFs or exchange traded funds are index funds. When it comes to an index fund, you are the market. So a common index that most investors would pursue in their retirement account or any general brokerage account is the S&P, which is an index or kind of a benchmark of US-based companies, the 500 most represented companies in the stock market. So if you hear S&P, which stands for Standard & Poor, that's an index or a benchmark or a baseline that effectively tracks the market and again has this diversification, so it's spread out amongst a bunch of different US-based companies. When you invest in that type of fund, you're investing in those types of companies, and as the market goes up or the index goes up, so too will your investment or go down. Generally speaking, these types of investments go up over time, and again, you can just pull up any type of investment graph or Standard & Poor index over the last 20, 30 years, you'll see the general trajectory is up and to the right. There's a lot of noise around investing in real estate. For the average investor, you probably just have one home that you're going to hopefully pay off. If you are someone who is purchasing multiple homes as an investment property, I'm probably not the best person to speak to that. You probably want to speak to a real estate investment professional because that's a little bit beyond the average investor. Again, the focus here is we try to make sense of personal finance, build our wealth, and construct a future that we want. If you're someone who is browsing multiple homes, vacation homes, rental properties, especially if you're leveraging mortgages and debt to do that, not my area of expertise. But that's not to say it's not a valuable investment for certain people. Another investment some people are constantly speaking about and saying there's a lot of value in are precious metals like gold, silver, even other commodities like oil. There is a place for this if you feel like you want to be protected from inflation. Data indicates that over time, precious metals and other commodities are not the strongest investments. If you have a very widespread portfolio and a high net worth, there may be a place to get some commodities in there. For most people, probably not something worth pursuing, but it is, I did want to mention it as an investment. Similar to gold and silver, you've definitely heard of crypto, more than likely, cryptocurrencies, things like Bitcoin, Ethereum, and so on. I'm not an expert on crypto. There may be a place for it in the future, but because there's nothing behind it, when you invest in a company or a fund, you're investing in businesses where there are people and goods and services. Cryptocurrencies are only worth as much as somebody is willing to pay for them. So as a result, it's probably not a good long-term investment play just because we don't know where it's going, especially as a means of slowly and deliberately building your retirement. Another type of investment is a bond or a fixed income type of source. A bond typically offered by a government like a municipality. They're very fixed. You know exactly what you're getting over what period of time, but the returns are generally lower just because it's not tracking the market. You're effectively allowing a corporation or a government to borrow a certain amount of money, let's say $5,000, and they will give you a coupon or a payout over every year, 2 years, however much is in the agreement. And you know exactly what you're getting. There's also tax benefits to these, but the return on bonds over time is generally much lower than things like ETFs, index funds. So that's a high-level overview of some of the different types of investments. The main takeaway that I would emphasize to the typical investor working a typical job who is just looking to build wealth slowly and gradually and deliberately over time are exchange traded funds, index funds, and mutual funds, ideally in your retirement plan, something like a 401k, IRA, 403b, etc. We talked about diversification earlier, and I want to go back to that just for a second because you'll hear a lot of noise and stories of individuals who have hit big on a stock or even hit big on Bitcoin or a crypto, right? They got 50x their investment. That is much more the exception than the norm. To that end, long-term investing and saving for your retirement when you get on a budget and live on less than you make, it really doesn't have to be that difficult. You don't even have to read up on different types of stocks or funds or companies or anything like this that might be intimidating to learn. For the most part, these funds that either track the market or mirror it closely, they're generally going to get you about 10% per year as long as you're prudent in your choices. And that compounded over time will lead to significant returns. There's discussions to be had around how much time you're looking at, your risk tolerance, and the types of investments and funds and how they've performed historically and then into the future. More on that another time. The other fund that I just wanted to touch on here really quick before we finish up today is a target retirement fund. If you have a 401k or 403b through your employer, you've probably seen this term somewhere. It is generally speaking a good play to invest in a target retirement fund. So what is it? A target retirement fund balances the aggression versus conservative nature of your investments from when you start contributing to what that target date is. So spoken more plainly, the risk profile or how aggressive you are with your investments will be higher earlier. And then as you go through time towards your target retirement year, let's say it's 2055, 2060, the way that the fund is balanced will be more conservative or less risky as you get closer to that date. Because let's say that something like 2008 or COVID happens near your retirement, if you were invested in very aggressive funds or aggressive companies that very much swing up and down with the market, if there's a downswing and you're trying to retire in a year or two, we don't want your portfolio sinking 10 to 15% or more. So as a result, what these funds attempt to do is have your investments be more conservative the closer you are to retirement, so that it is less subject to the market going up and down, and you can sleep easy at night knowing that in the last few years to your retirement, you're not going to see a lot of up and down swings in your investments. You're just going to kind of get what you see. Hopefully this high-level overview is helpful for you with just either solidifying your knowledge or learning something new. When it comes to answering the question, what is the best investment for me? And again, whoever you are, where you are in your investment journey, your wealth building journey, the answer is it depends. For most people, as I mentioned earlier, mutual funds, index funds, ETFs, all in a retirement tax favorable account is generally going to be best, but that does not mean that that's the only thing that an investor should consider when looking big picture and long term. Those types of funds, again, ETFs, mutual funds, index funds, are generally safe. They go with the market. They have compounding potential over time. There's less inherent risk than a single stock, less inherent risk than Bitcoin or other cryptocurrencies, meaning that if that investment that you choose, and I even hesitate to call crypto an investment, but that's a conversation for another day. Mutual funds, index funds, ETFs, do a little bit of homework, check their records over the course of 5, 10, 20 years, make sure that they have at least kept up with the market, if not done better than the market. If you find some of those, maybe one or two for your retirement portfolio, it has inherent diversification, which means that, again, when you put your money into that mutual fund, exchange traded fund, or ETF, index fund, and we also mentioned the target date retirement fund, if you're putting money into that, you should be in good shape. Again, it always goes back to the behavior. Are you doing it consistently over time, allowing compounding interest to work for you so that in 10, 20, 30 years, your future self, right, at retirement age will realize I did the right thing at that time by putting money aside, thinking about my future self and my retirement, and I didn't get involved or engaged in speculative investments, namely the cryptocurrencies, whatever the latest fad is. These are proven over time, not super difficult to comprehend. There might be nuances of these investments that seem confusing. Let me know in the comments if there's any information about any of these investments that I can further clarify, or if there's an investment you heard about or want to know more about that maybe I can go more in depth about or address in the first place. I'll be more than happy to do so. There can be a lot of information when choosing your investments. It can feel intimidating, it can feel risky, all of which is totally understandable. That's why there is a little homework that needs to be done so that you can sleep at night knowing that these investments that you choose, namely these funds in a retirement tax favored account, 401k, 403b, or IRA, are doing what they should be doing and growing, compounding over time while you sleep. Hopefully this video was helpful for you. Again, let me know in the comments if I can expand upon any other points in here and help you answer the questions about investments as they relate to your specific situation in another video. Thanks so much for watching.